Thank you everyone for joining today's webinar. We're going to give everybody about 20 seconds before we kick off today. All right, I see the room starting to fill up. Thank you again for joining us. We've got an exciting presentation for you today. The topic for today's webinar is how to give your board the financial clarity they need. Let's get going. So for those of you that don't know me, my name is Omar Visram. I am the co-founder and CEO of Enkel. I started Enkel about 10 years ago after spending most of my career in public accounting, where I worked with small businesses and not-for-profits. As you know, this is a co-hosted webinar today with Thriving Non-Profits. And I'm delighted to be joined by Lee from Thriving Non-Profits. Lee, would you like to introduce yourself briefly?
Sure. Hi, folks. I'm Lee Heron. I'm the director of Thriving Nonprofits. I've got more than 25 years of leadership experience working in the public and nonprofit sectors, including 10 years as an executive director of a multi-service organization. I've sat in my career on both sides of the board table. I've been a board member for more than 25 years, and I've probably attended more than 300 board meetings. So I'm looking forward to this topic. I've seen a lot of financial reports go by over the years, and I've seen the good, the bad, and the ugly, let's say.
Excellent. Excited for this conversation. Thank you, Lee. In terms of agenda, the way that we will run the session today is it'll be a guided conversation between Lee and myself. Lee will bring forward common board level questions based on what he sees with nonprofit leaders and boards, and of course, drawing on his experience, those 300 or so board meetings that he's attended. And I'll respond with practical finance guidance and examples. We will save time at the end for questions, so please do put your questions in the Q&A box. We will do our very best to get to them. All right. First, a little bit about our two respective organizations. So for those of you that don't know, at Enkel, our mandate is to help organizations gain clarity and confidence in their finances. We've supported thousands of organizations. What we do, we really break into two distinct categories, one being financial operations, that's bookkeeping, payroll, and accounts payable, all of the process-related finance activities that happen to keep your organization moving forward throughout the year. And then there's our financial management support layer, which includes CFO and controllership services. Our clients usually buy a combination of the two, but we do provide each of them independently. I would like to acknowledge that our head office, where I'm located today, is situated on the unceded traditional territories of the Musqueam, Squamish, and Tsleil-Waututh nations. I also want to add that Enkel is proudly SOC 2 certified, so every year our systems are audited for security and compliance so that we're able to demonstrate that we're holding to your data to the highest standard from an operational and security standpoint. Lee, over to you.
Sure. Thanks, Omar. So our organization started the Thriving Nonprofits Revenue Diversification Program in 2015 as a cohort to help nonprofit leadership teams build revenue diversification strategies. Since then, the program has grown from a local offering into a national one, with cohorts running across Canada since 2021. Along the way, we've added a few quite innovative additions, including the Thrive Impact Fund, which provides values-aligned investment capital to nonprofits and charities, repayable capital. And we continue to build out our curriculum on governance, social enterprise, access to capital, and other topics. The Thriving Nonprofits team delivers on three pillars: learning, coaching and consulting, and investment. And together we've worked with over 500 organizations across the country in the last several years.
Okay. Let's start with an interactive poll just to get a little bit of feedback from the audience today. So our question is, how confident is your board in reading your financial reports? Option one is they're confused at every meeting. Option two, they get the basics but ask a lot of questions. Option three, they understand it but don't engage much. Option four, they read it confidently and ask great questions. And option five, they have crystal clear confidence. They are fully engaged. Let's see what you have to say. All right. Okay. So 10% of you said they're confused at every meeting. 20% said they get the basics but ask a lot of questions. 58% of you said they understand it but don't engage much. 12% said they read it confidently and ask great questions. And nobody said confidence, they're fully engaged. Maybe you're just being humble. But let's see, there's a lot of people in the mid-range, which makes it sound like we can probably help to move that needle forward. All right, let's keep going here. Lee, over to you.
All right. Well, first question for you, Omar.
Yes.
Um, Given that what we've just seen, maybe not all boards are struggling, but a certain number are, maybe 40% according to that poll. So why do boards struggle to understand financial reports, even though they get one, like I said, every month? Again, my experience is very similar to the poll. I would say that and it varies across the board. So we're sort of making an assumption that, um, everybody's the same in the question, but in fact, there's some board members who may be crystal clear. They're very much in the minority. Most board members may sort of understand, but they don't ask a lot of good questions, and then a certain number of board members are hopelessly confused. So how can we help them?
Yeah. It's a great question. We see this a lot. It really comes from a place that board members have varying levels of understanding of finance. I think that's really, what a lot of the core problem, where a lot of the core problem originates from. And that's not something that we're going to change. And we have to remember that the stakes are high. Canada has over 170,000 registered charities and nonprofits. The nonprofit sector, we hear it time and time again, is really a critical part of our economy. When boards can't understand the numbers, they can't confidently govern. And the result is slower decision making, weaker oversight, executive directors carrying too much financial risk alone, and missed opportunities to protect the mission. The result is slower decisions, weaker oversight, and missed opportunities to drive the organization forward. So if you think about this at scale, impacting such a significant aspect of our economy, this is a really important problem that we need to address. So the problems that we see, just at a high level before we get into the details, are outlined here. Unclear reporting, so dense statements, no narrative, no context, just these, long reports coming out of QuickBooks that provide too much information. Confusion between restricted and unrestricted contributions, so boards can't see how donor funds are being used. This next one is interesting. So, role ambiguity, no clear boundaries between the executive director, the treasurer, and the board. So, who's even responsible for generating these statements? Not necessarily clear. It's maybe a bit of a group effort. Are we really reviewing? What are we looking at? Low financial literacy, board members don't feel confident enough to ask the hard questions. And then disconnected reporting. So the budget, monthly reports, and annual statements do not line up, making it hard for boards to connect the full financial story. So what you often see is really there's three versions of truth in the financial reporting process. And if they're not connected, that can lead to different stories, different assumptions, different conclusions. So let's talk about what we see a lot of versus the way that we encourage organizations to change. So, historically, long financial packages sent 2 days before the meeting, 2 days if you're lucky, line by line variance analysis on $500 discrepancies, static balance sheets that don't show cash runway. Um, we're profitable or we're solvent, but cash is tight, really a bit of a unclear story there. So what we recommend to our clients is have a one-page visual dashboard summarizing financial health. I do think it's important to provide good quality income statement balance sheet, but put a one-page summary at the front of it. Focus on the key 5 metrics that drive the mission forward, and it'll differ for every organization slightly. Have forward-looking cash flow projections, um, and be able to say, here's our runway and the decisions we need to make based on this runway. Boards really need insight, not just a dump of financial information. So we put together visualizations for our clients all the time that help to get away from these traditionally quite dense reports into reports that look like this. So you can see on the left, this is a very simplified balance sheet, but in many cases, this is all that you would need. You don't have to have, a full list of your fixed assets with every computer, computer software, $1,000, desks, $2,000. This may be all you need. But then below, you provide some supporting visualizations that tell a better story. For instance, the ratio of current assets and current liabilities, whatever it might be. And you probably want to engage your board in actually building these out in the first place. And then on the right, we have a more simplified profit and loss or income statement. All right. Um, I mentioned on the previous slide, provide a snapshot, key metrics, and they will vary organization to organization. These are the ones that I'd say we see very commonly, particularly if, in an environment where there are concerns about liquidity, about sustainability of the organization. And these are conversations, of course, that we see across the sector more than we've ever seen before. But the first one here is cash runway. So how many months can you operate on cash on hand alone, right? Pretty good question. Is it 1 month? Is it 6 months? Is it 9 months? That may change the decisions we're making at this board meeting today. Operating reserve ratio. So unrestricted net assets divided by average monthly expenses. We typically say have a target of 3 to 6 months of expenses. That is just a target. It may be more in some situations, usually not less. And then the program efficiency ratio. So program expenses divided by total expenses. Typically, we see this in the 70 to 80% range going directly to programs, but sometimes, of course, it can be different. 4 is budget variance, so year-to-date budget versus actual, so actual revenues and expenses versus budgeted amounts year-to-date, and flagging variances greater than 10%. The one thing I want to say that in order for this to be an accurate picture and for you to not really be living in two different realities, your budget needs to be built based on your chart of accounts in your accounting software so you can easily run a budget versus actual every month. And your financial statements need to be prepared in accordance with the accounting standards, as does your budget, so that the two are actually sort of saying the same thing, speaking the same language. And then 5th is revenue diversification. So how your revenue is broken up. We often see this in pie chart format. Maybe there's a goal you're working towards in order to diversify revenue. But what is that, risk? Basically, is all of your funding coming from one place? How is that picture evolving? So here's a simple example of how a simple ratio might lead to some action. So in this case, a not-for-profit has an operating reserve ratio of 1.7. So $96,965 in average monthly expenses over about 170,000 in unrestricted net assets. So what this is saying is that this organization can cover less than 2 months of expenses with unrestricted funds. The board needs to perhaps discuss a reserve building strategy. This is the kind of conversation that you can bring to the board with numbers. Lee, back over to you.
Thanks, Omar. That's really refreshing. I love seeing that dashboard. And boy, I said I'd seen the good, the bad, and the ugly, but I've never seen a dashboard like that presented by management in a board meeting. So I would really welcome seeing something like that. So you did raise this a little bit, but this is actually something that we see all the time, is that the executive director is building a budget in Excel the way they think about the organization. The bookkeeper, who may or may not have deep skill in accounting, is working off a chart of accounts that may have been set up 5 years ago, but has sort of changed and shifted over time and may or may not map to the executive director's mental model of the organization and how it is today versus how it looked 5 years ago. And then at the end of the year, the board gets financial statements prepared by an outside reviewer often. And like you said, those are, set up in a way by that outside reviewer in order to meet the needs of reporting to the CRA or potentially, adhering to the accounting standards. And so what you've had over time is this divergence in these three pictures of the organization. And unfortunately, the board is exposed to all three. They get the budget at the beginning of the year in one format, monthly or quarterly reports through the year in a different format. And at the end of the year, they get asked to sign off and approval statements that are in a third format altogether. And to me, this is, in sitting on boards, been a tremendous source of frustration and confusion for board members because they don't understand, like they can't mentally reconcile these things, and they're not certain that, in fact, there is a reconciliation underneath them at all. So what do we do about that?
Yeah, and when the times are good, this is an irritation, perhaps. But when the times are tough, and you get those year-end audited financial statements, and you suddenly have a $200,000 deficit when you thought you weren't going to have a deficit, that can very quickly become an existential issue. And I've actually seen this before, right? Um, let's dive into this a little bit. There's, of course, a number of different pieces to this. But over time, as we've talked about, nonprofits end up with three different financial views. The executive director manages the budget in one format. The bookkeeper reports from the accounting system in another format. And again, maybe not in accordance with the accounting standards. We got the grant. The grant is revenue this month, irrespective of when we spent the funds. And the year-end statements are prepared in a different format for audit review or compliance. So, of course, this becomes hard for the board to follow and to connect the dots. What we need to do is we need to create a clear line of sight. As I mentioned, the budget needs to be prepared in accordance with the chart of accounts. So it's basically take your chart of accounts out of QuickBooks or whatever accounting software you're doing. And that is really, those are the line items you need for budget purposes. And then make sure that you're reporting, of course, in that format. And your year-end statements might roll up a little bit differently, but they should, of course, balance out. Like your net assets should balance out. Your revenue recognized should balance out. If there are year-end adjusting journal entries, those need to get reported or pushed back, those adjusting entries into the accounting system. Also, restricted versus unrestricted funds is another source of divergence between different statements. So, three mistakes that create confusion and risk. The first one is mixing restricted and unrestricted funds. grant money is used for general operations or unrelated expenses, or it all just gets dumped into one bucket. Mistake number two is poor documentation of those restrictions. Grant conditions are just not clearly recorded when funds are received. And then the third one is overspending on budget categories. So spending exceeds approved limits, such as admin caps and salary lines. This is where you want to make sure you have your controls in place. So you set the budget, and how are you following through on making sure that those budget lines are actually assigned to a team member, owned by a team member? The executive director often ends up owning a lot of those lines. But how do you hold the team accountable for making sure that spending does not exceed what has been budgeted? Um, so having your board exposed to some kind of education on fund accounting and just the basic mechanics of fund accounting is often a good idea. Even if cash sits in one bank account, your accounting system must track it in separate virtual buckets based on donor restrictions. And there's different ways of doing this in the accounting system. In QuickBooks Online, of course, you can use different deferred revenue accounts, and you can use classes to report revenues and expenses on different programs. Your board should clearly show, or sorry, your board report should clearly show unrestricted funds available, restricted fund balances by grant or donor, and what restricted funds can and cannot be used for. So usually a summary and explanation, just to remind the users of the financial statements as to what those restrictions are. The board should never have to ask the question, can we use that money? The report should ultimately answer it for them. All right, Lee, back over to you.
All right, so you've mapped out some things we can do to improve the quality of the statements going to the board and hopefully increase their engagement. But how do we ensure that the whole team that's responsible for the organization, stewarding the organization's finance, um, is having the best possible conversations? How do we make sure those conversations are, yeah, focused on the future and strategic rather than looking backward at small variances or, minor issues which aren't material to the future of the organization?
Yeah, great question there, Lee. So I think, first of all, it's important to take a step back and really understand roles within an organization, who is responsible for what. Really, we see this confused quite frequently, what board's capacity as in governance means and what management's role actually is. And there's often a blurring of lines here. But the board's role in finance is oversight and strategic guidance. Management's role is day-to-day operations. Bookkeeping should be done by the management team. From a budgetary perspective, the board is responsible for ensuring it aligns to the strategic goals of the organization. Management's role is to build it. Reporting, board's role is to ensure that they understand it. Management's role, again, is to prepare it. Risk, the board will set the comfort level. So, do we want to look at different scenarios? Are we comfortable with a small deficit this year? Do we want to build a surplus? And management informs those decisions. From a compliance standpoint, the board is responsible for ensuring that accountability measures are in place, and management is responsible for executing filings and control, ultimately making sure that team members or that accountability is assigned for the different line items on the budget. So you may want to think about it this way. The executive director is responsible for everything, but they may delegate certain line items to different program managers or team members as it makes sense to do so in the context of the organizational structure. The board ultimately leads, management runs, and confusion between the two is where oversight breaks down. Um, so let's talk about three distinct roles in the organization: executive director, treasurer, and board directors in this context of creating one financial oversight system. So the executive director is accountable for the finance function, delivering what the organization needs, owning the outcome, but they shouldn't be doing the bookkeeping, but they're responsible for making sure the bookkeeping gets done through a contractor, through an employee. The treasurer liaises between management and the board, lends bidirectional assurances, helps the board see around corners, and actively engaged in the audit. I would say in an oversight capacity, in budget review and risk management. The board of directors connects financials to the overall direction and strategy. They act as the safety valve and they should be asking hard, challenging questions. They should stay out of day to day wherever possible, but of course, be there to really challenge the numbers and make sure that the numbers are aligning with the overall strategic direction of the organization. Um, I think this is a good exercise to do in an offsite capacity or once a year at the board level with the executive director. So build a RACI matrix. For those of you that don't know, lots of good resources for this online. R stands for responsible, who does the work. A stands for accountable, who owns the outcome. C is who is consulted, as in who provides input, and who is informed, as in who is kept in the loop. There's a visual here on the slide that can help you understand in the context of preparing financial statements, who the um, RACI is, same for reviewing the budget versus actuals, presenting to the board, approving financial reports, and flagging material variances. So what I would suggest is build a RACI matrix for the organization based on the key steps of the financial processes in the organization. Get that down on one page just to make sure that everybody is aligned. And review it from time to time. Make sure that certain people aren't overstepping. A very classic one that I see, by the way, is situation where an executive director is not a finance person, but the treasurer is. The treasurer gets into the QuickBooks file, asks questions, eventually starts changing transactions. That is something you should avoid. If you want to think about it in QuickBooks context, maybe your treasurer has view-only access to the file, but that is the most. They should not be processing transactions inside of QuickBooks. The meeting before the meeting. I think this is a little bit ironic because typically we want to avoid meetings for the sake of meetings, but this is an important one, I will say. How to best prepare for the board meeting. The treasurer and the executive director should connect before the board meeting, walk through the financial package together, agree on the 2 or 3 items that need board discussion or approval, anticipate questions the board is likely to ask, and align with the narrative. What did the numbers mean for the mission? The result is the board arrives informed, not confused, and discussion time is spent on decisions, not explanations. In order for this to be possible and to create this kind of fruitful conversation, of course, the treasurer and the executive director need the financial numbers. They need the actuals, they need the budget versus actuals, and they need that one-page summary before these meetings happen so that everybody can come to the meetings having done their due diligence. So what that means is your financial reporting process, the monthly workflow, really does need to be mapped out in detail so that you can be clear that come meeting number one time, both the executive director and the treasurer have access to the reports that they need. So strong boards use financial insight to guide strategy, not just to approve reports. So this really requires clear reporting, defined roles, sound policies, and consistent processes. That's all we have for today. So we have plenty of time for questions. Before we go there, I did want to just offer that we have built this guide. It's called the Audit Guide for Canadian NPOs. We launched it earlier this year. It has been quite popular, so please feel free to scan this QR code. We will also make this guide available to you after today's session. And another thing that we've really been helping a lot of nonprofits with this year is what we call a financial diagnostic. So this is a small paid project that an Enkel CFO can undertake with your finance team, your broad finance team. What we do is we work on bringing one summarized, clear view of where the organization's finances are. We look at really some important pieces of the overall finance function. We look at technology, we look at controls, we look at board reporting and how the board and management team are interacting. We conduct our work by interviewing key stakeholders. We document the risks, control gaps, reporting improvement opportunities, oh, and KPIs to measure. So building that one-page summary. In there, you will get practical recommendations with specific context, challenges, and limitations that will be taken into account. And we will meet to walk you through these recommendations and build a roadmap to help you optimize your finance function. You can click the link down here. Again, we will make it possible for you to connect with us if this is of interest. And finally, our five core services. Just in case you missed it at the beginning, we provide bookkeeping, payroll, accounts payable, fractional controllership, and CFO services. We'd be happy to connect with you if there is a need for these services in your organization. And Lee, over to you before we get into the Q&A.
Sure. Thanks, Omar. As I said, our organization, the Thriving Nonprofits team, provides learning services, coaching, and consulting support to executives and nonprofit leaders, as well as providing access through Thrive Impact Fund potentially to values-aligned investment repayable capital. Please click the link, reach out, book a discovery call. There's no cost or obligation for it. We'd love to get to know you. We'd love to meet you and hear about the challenges you're facing. The great thing about hiring consultants is hopefully the consultant has seen the problem before. So yeah, hire Omar if you need fractional controllership. He does that for a living. But call us if you need help with strategic planning, feasibility studies, business planning, help with governance, strategy, yeah, that kind of thing. Anything like that, we're all over it. So please give us a call.
Great. All right, let's dive into Q&A. Lots of time. I'll just go full screen for that one.
Yeah, so I jumped the gun, Omar, and answered one question already, but I'm just going to run it by you for the whole audience because I'm not
Sure.
sure if everybody's looking in the Q&A box yet. So the question was from Lana. We're an education-based nonprofit where our tuition accounts for 98% of our revenue. Now, obviously, she says that's higher than the 25% risk zone. Is there an exception? And I, like I said, I jumped the gun and answered, but the answer I gave was that if your tuition is coming from many different payers who aren't related to each other, then let's say you have 100 students and they're not relatives, then it's already relatively diversified. The economy might go down but you're not going to go from 100 students to zero in all likelihood. And that's what we look for in diversification. The risk, though, is, recently we've seen this because we have clients who are in the provision of language services space. And they have actually been tremendously stressed because their client base is correlated. It's linked to federal policy around immigration. And so when the federal government a few years ago started to restrict foreign visas for to attend school, that actually put tremendous pressure on some of our clients. And so that's the risk, Lana, that I see. What do you think, Omar?
Yeah, I totally agree with that statement, Lee. I think one of the challenges I have with sharing these kinds of numbers is, I'm talking averages, right? And every organization is unique, different. But I would agree with that, that you do sort of have a built-in diversification mechanism in the organization. The other thing I'll say though is just by looking at the number, right? It's not necessarily a bad thing because it may, like if you have a graph that, shows where the revenue comes from, that may trigger some discussion around, okay, can we go apply for a grant? Can we set intentionally a goal of stretching into a new revenue source, right? That helps. Maybe that's not a good use of time, but doesn't hurt to be looking at the number.
Great. Thanks for that answer. So we got another question here from Stella. Is the cash runway metric that you introduced in the first segment there based on unrestricted cash? Most of the grants that they have are highly restricted. So do you want to just say a little bit more about that and clarify?
Yeah, yeah, good question. I typically like to think of it in the context of unrestricted cash. That's usually where organizations have the greatest challenge. And honestly, the number of times that we've seen organizations fail because of a lack of unrestricted cash, um, it's concerning. So I would say it's generally based on unrestricted. That's usually the way that we present it.
And like you said though, I mean it's it's challenging if all of the cash is restricted and unrestricted is commingled in one bank account and you don't, through your financial reporting system, have visibility into the portion that's restricted and the portion that's unrestricted. There's a real temptation if times are tough to dip into the restricted. Do you want to say anything about that?
Um, I want to say don't do it, but it's something that I understand the challenge there. Um, I don't think so. I've seen a lot of organizations set up separate bank accounts just to it there's separate pots of money. No confusion then, right? I don't think that's necessary. I would say make sure that you have a strong handle on the deferred revenue, right? Make sure, like, the reality is QuickBooks doesn't have a great deferred revenue module for not-for-profits. You need to keep an external deferred revenue schedule, and that schedule needs to tie back to QuickBooks every single month.
Great, good advice, and I I heartily concur with what Omar just said. So, question here from Anonymous. So, the financial statements at the end of the year towards the public can slash should be different from internal statements. I'm not sure that's what we said, but how do you want to respond to that, Omar?
Maybe they'd be different in the level of detail that they provide, but the underlying numbers should not be different. And I think maybe we're saying the same thing there.
Yeah,
Um, I'm not sure, but you definitely should. So you should, best case, you have no audit adjustments at year end. Usually there's a few, right? It's when there's an extensive number, that's when you have a challenge. But what you present in your annual report should be a more summarized version of what you're looking at internally, I would say.
sure. A couple of questions here, one from Barbara and one from Martin, about the particular challenges faced by small organizations. And I'll just read both of them, but I think you'll be able to respond to both questions with one answer. So Barbara says, we're a very small not-for-profit with just a board of directors and no staff. It's always challenging to be professionally in control and welcomes any advice. Martin says, a small nonprofit often does not have an ED, a treasurer, and a bookkeeper further to your RACI matrix. So in our case, the treasurer does the bookkeeping within QBO. And frankly, like that is a thing that I've seen, more times than I can count, really. So how would you refine these roles for a small nonprofit? And then Martin adds, um, to add to that, we're impecunious, which it's too bad you're not getting paid by the letter, Martin, because that's just a fancy way of saying we're broke. So what do you think, Omar?
Yeah, and ideal world, I would say, you know, find a bookkeeper, but I totally understand the challenge that so many nonprofits have. And so I think in those situations, you just have to be practical. Make sure you have controls in place. And simple controls like is one person preparing the bookkeeping? And is another person responsible for making payments, right? Um, so when I say, the treasurer should not be involved in the books, I know that that is really for, organizations that are a little bit larger, and I won't quite give a number in terms of operating budget. But where you have that challenge, just make sure that you mitigate the challenge with controls, I would say.
If I can add a little bit to that, just from a recent client that we've been working with. I mean, this is an organization where the budget has just crossed $600,000 and the treasurer is still doing the books. The reason that that has happened is because the organization has grown through time, and it's a little bit like the proverbial frog in the pot, where when the organization was very small, the treasurer said, "Well, I'll just do it. It's no big deal. I'm a CPA. I know how to do this." And then suddenly, in retirement, the organization 10 years later has grown, and now it's a part-time job that they didn't sign up for.
Yeah.
Um, I think, I mean, what would you say to that, Omar, in terms of like, where is that? You
Yeah.
said you didn't want to draw a line, but I'm
Yeah.
encouraging you to give a hint as to
Okay.
where you
That
should draw that
is
line.
that is exactly the scenario we want to avoid, right? Um, it's usually okay, if I have to give a number, you've pushed me on this now, Lee. It's usually around like the 250,000, maybe even a little bit smaller point where you should start budgeting a little bit of money for bookkeeping, right? Even if, and you can keep bookkeeping costs lower by having quarterly bookkeeping done, there's ways to manage the cost. But it is important around that point to start getting independent bookkeeping.
Yeah, I'm in full agreement with that. There's a question there from Debbie, which I'm going to let you folks answer just online. But here's a question. When an executive director, again from another anonymous attendee, when an executive director has had full reign over the finances of the organization for over a decade and has never been asked a hard question or they've never been put into question, how can a recently renewed, more active board begin to insert itself into the process? So yes, this is something we've seen before too, right? Where, somebody's gotten very accustomed to just making all the decisions in that responsibility accountability matrix and not sharing decision making or even necessarily sharing a lot of information and consultation. So how do we start to reassert that, Racy, in an organization that's kind of drifted away toward single person control, which of course is against the idea of separation of functions entirely?
Yeah. Yeah, I agree, Racy. And I would also say ask to see the organization's policies, like finance policies. When was the last time they were updated? Are they reviewed regularly? This is where the board, um, you know, needs to ask questions.
Okay. Um, Here's a question from Adina. The budget we prepare aligns with the chart of accounts, so good on you. We've always done it annually. In order to see how the year to date compares with the budget, should we actually be breaking that annual budget down into a monthly budget,
Hmm.
which Adina rightly points out is a lot of work because the organization is seasonal, and so the expense and revenue vary dramatically from month to month through the year.
Yes, you should prepare a monthly budget. You're absolutely right. It is a little bit of an exercise. It's usually a harder exercise the first time you do it in that format, and then you can leverage off of it in the future. Um, it's not good enough in most organizations to just take an expense and divide it by 12. Some expense accounts, perhaps like rent, right? But others, for the most part, you do want to thoughtfully go through line by line. The other thing that I thought of as this question was asked is, in order for it to be meaningful, you do need a forecasting model, right? So budget versus actual, you report on, but if you're at May, you're a calendar, fiscal December 31st year end, and you're at May, your budget versus actual is going to be far off and it's not really going to tell a story. So you do need to then add in what your expected, remaining 7 months of the year are going to look like to understand where we think we're going to land at the end of the year, right? That's an important one, I'd say.
Here's a great question from Toby, and with your forbearance, Omar, I'd like to answer it. Take the first
Yeah,
crack at
please.
answering it, and
Sure.
then hand it to you.
Sure.
So the question is, I'm an ED who does the bookkeeping, and I've found that by the time I give the bookkeeper the allocations, I might as well do the entry myself. I have a bookkeeper that looks over my work, but can you say more about why an ED should not do the bookkeeping? And the answer that I would provide, and we'll see what Omar says, and maybe we'll agree, and maybe we won't. That'll be fun too. But the answer that I would provide is that it's very hard if you think about, wearing glasses or or looking closely at something in front of you with a microscope versus looking at something that's in the distance with a telescope. You can't do both at the same time. And so, if the executive director who's charged with the whole health of the organization is looking in the microscope, they're not looking in the telescope. And so, I'm not saying that, again, in that small organization, if you have a financially capable ED, that you might find that, spending 10 minutes a day is enough to keep on top of the bookkeeping. And it's probably good because you don't have a lot of money anyways. Keep your finger on the pulse and all that. But if the organization is going to grow, and as we say, thrive, it's going to require building relationships out in the community. It's going to require finding other sources of funds. And you're not doing that while you're, allocating payroll by program. And so, there's there's a role for being engaged in the finances and understanding them, but as a means to deliver your mission. Your mission is not in the books. Omar.
I agree with that. We see this a lot where nonprofits just think bookkeeping is too expensive. We've got to just do it ourselves because we don't have the funding. But how is that preventing you from spending your time achieving your mission? That is one side of it. The other side of it is, I would just say, segregation of duties and, um, you know, having a second set of eyes on your work, I think is always valuable in this context in particular, right?
So
Um,
that, don't
I
go
would,
ahead. Sorry, I don't go. Please carry on.
I was just going to say, I see if you can try to expand the role of the bookkeeper. Again, I know this is probably related to cost, but I would continue with that, um, with the process you have there.
I'll offer a final, I would urge you to, to follow my advice and not follow my practice. Because as an ED myself, I fell into this trap where there were many things that I could do more efficiently than my staff. And to actually sit down and explain it to them, I thought, well, I'll just do it. 10 years later, I was just doing a bunch of stuff that kept me busy all day um, because I hadn't offloaded it. And so I would say, as an ED, if you're hoping to grow and expand and deliver more and more on your mission, lay off any task that isn't looking through the telescope. And if it takes time, spend the time, because you'll spend the time once, twice, maybe three times, but then the person will confidently and competently do it on their own, and you'll be free to go and do the next thing.
Yeah,
Um, you
agree.
said segregation of duties, which was it was a great part of that answer that added to, what I was already thinking about, Omar, and that's great. Rebecca asks, how do you segregate duties when you are a working board? And so this is again potentially a board that doesn't have staff. What would your advice be there?
Yeah, it depends on what process we're talking about. I'm just going to use payments because that's usually the one that comes to mind when you think of segregation of duties. Like have two board members required to approve payments before funds are released from the bank account, right? Or have a different person reconciling the transaction in the accounting software versus the one who's able to hit the final approve button. That's what we mean by segregation of duties. It's basically, if you want to think about worst case scenario, what could go wrong here if somebody had malicious intent. Um, how do we prevent that from happening by having other people involved?
And we never do want to think about that, but the fact is, in my own experience, just in Greater Victoria here, over 25 years, I can think of two, which isn't 200, but two organizations that were fairly sizable that completely went under because of a lack of a segregation of duties. And someone who had the ability to put amounts into the system and approved them, funneled the money to themselves, and ended up in jail. But in the meantime, the organization declared bankruptcy and wound down. So that's the worst case scenario. Our board does not have a treasurer. This one's from Maria. Instead, we have an external accountant who prepares monthly reports. Should we have a treasurer?
The answer to that is ideal, but I know it's not always possible, right? I would say keep looking. But in the interim, ask the external party that's preparing the books to prepare that one-page summary and really make it digestible for the board. That's really the best you can do in this circumstance. But I'd say, yeah, don't quit looking, but it is a reality we're in. It's hard to find a treasurer.
Right. Here's another question from anonymous, perhaps a different anonymous person, but nonetheless. As a new ED, and this is, I like to say when people tell me that they've been appointed as the ED, and instead of saying congratulations, I say my condolences. But as a new ED taking over a financial system or lack thereof from a disorganized predecessor, how do I go about creating structure and bringing the board in while still maintaining boundaries, which I'm assuming also means getting on with fixing the things that need to be fixed?
Yeah. Um, So this is a tough one, particularly if you don't come from a finance accounting background or you've never seen, a good system implemented before. There are a lot of bookkeepers out there, bookkeepers, controllers that can help you get this set up because they've done it before. So this is where you may want to seek some external help. What I will say is there's a lot of really great tools today that actually, when you implement them, they bring efficiency, but they also bring controls built in with them. So I'm sure many of you have attended our webinars and you've heard me talking about Pluto. Well, Pluto is an efficient payment tool, but it also um, allows you to build in approval limits, right? So that you can make sure that, payments are only leaving the bank account when the appropriate people have signed off electronically, that is. Um, so that would be my recommendation is if you haven't done it before, find a service provider that can help you do it and think about how technology can help you really get to where you need to be.
And I agree 100%. And again, follow my advice. Don't do what I did, which is try to figure it out yourself. Engage a professional. It's easier to do that the smaller the organization is, because it's less expensive and it's simpler to set up the systems. As the organization grows, if you're successful in your role as an ED, you'll be expanding the organization. It gets harder and harder to sort of create that system once it's bigger and to sort of get the advice. It gets more and more expensive. So that would be my advice. Omar, we're coming close to the top of the hour. I think we've answered most of the questions that aren't specific to, you know, the template and
Yeah,
or the guidebook or other things that you
yeah,
talked about. And so I'll let you folks answer those questions
sure.
directly with people. But yeah, any last words?
Great. Just wanted to say thank you. We're really excited, Lee, to be, of course, partnering with you. This is our first webinar, hopefully first of many. And thank you to the audience for taking an hour out of your day to join us and talk about this important topic. And if, thriving nonprofits or Enkel can be of help, please don't hesitate to reach out.
Yeah, and from us here at Thriving Nonprofits, was a great pleasure to be part of this, and I hope we can team up again. Thanks very much.
Thank you, everyone. Have a good day.
Bye for now.